Hello everyone. This is the second time I'm recording this. Last time the mic didn't work. So hopefully this works properly now. I'm in my office at work and there seems to be quite a bit of noise around here today. So if you hear some noises in the background, please excuse the audio. Okay, what we're going to do is we're going to post the information from these transactions directly to the general ledger accounts. Maybe the examiner asks you like this. Now, what happens normally is all the information would get recorded in the general journal. So you would take the information, you would have transactions, and you would record the information. It would go transactions, T for transactions. All the transactions would be recorded on documents, source documents, let's call it SD. Then these documents would be recorded in subsidiary journals. Then the information would get recorded or get posted from the subsidiary journals to the general ledger accounts. Now the examiner is asking you to take the information straight into the general ledger accounts because the test is on the general ledger accounts and also the principle of double entry. So that's what's going to happen in this exercise. So let's have a look. Let's get on to it. First thing, when you do general ledger accounts, you look for opening balances. The opening balances, if there were any, are normally listed in the information before you start the exercise. In this exercise, there are no opening balances. So let's move on to the transactions. It says here, take the information straight from the transactions and put it into the general ledger. So on the first, we are doing the transactions for April 2025. The year end is December, and we're doing the transactions for April. On the 1st of April, the owner increased his capital contribution by depositing 180,000. Now I'm going to do this for the first couple of transactions. We'll use T accounts to explain the debits and the credits. Every time you do a transaction, you read the transaction, you identify which accounts involved. In this example, on the first, the owner put money into the business bank account. One of your accounts will be bank. If the owner puts anything into the business, it will get recorded in the capital account. The owner normally makes a cash contribution or can contribute an asset. In this case, the owner contributed 180,000. Bank is an asset if there's a positive bank balance. The business bank account has increased. So the bank account will get debited. According to the business, the owner has a bigger interest in the business because there was an increase in capital, and an increase in capital, the account will get credited. And the amount is 180,000 and 180,000. Now these are just notes or T accounts I'm using to explain this. The question says, put the information directly into the general ledger accounts. So let's see if I can move down. We debited bank and we credited capital according to the accounting rules. This transaction took place on the 1st. Put the information into the general ledger accounts. I've already entered the dates. In a test, you will get a template like this, and you will have to complete the general ledger accounts. Now, under details is the name of the other account that was affected by the transaction. We are in the capital account. We are doing the capital account. There's the heading there. The other account for this transaction was bank. Normally under folio, you have journal references, but you weren't asked to do the journals, so you can put the money or the amount straight into the amount column. The transaction was posted straight to general ledger account, and this, I remember, was 180,000. The owner put 180,000 Rand into the business. Credit capital, and we debit bank increase in assets. That is the credit side of the entry. Remember, the right-hand side is the credit side. So capital was credited, and if I go to the bank account, bank was debited. On the 1st of April 2025, under details now, we write the name of the contra account, and the amount is 180,000. Now I've done the debit entry in bank and credit entry in capital. There it is. That is transaction number 1 on the 1st of April. Let's go to the 3rd. The business purchased equipment on a hire purchase agreement for 250,000 Rand. I'm going to use T accounts one more time. So the business purchased equipment, and the equipment was worth 250,000 Rand. A deposit of 100,000 was made, and the rest would be paid in 8 equal installments. 100,000 was cash, 150,000 was actually bought on credit. So there are 3 accounts involved, yeah, but your debits will still equal your credits. You will see. That is equipment. The value of my equipment was 250,000. Equipment is an asset, increase in assets. The rule says debit 250,000. I'm leaving out the notes. I'm just explaining this. Now the contra accounts here, they are bank and accounts payable. I will show you why. There was a deposit paid, bank, cash, 100,000 was paid. I entered this on the credit side. 150,000 we owe, and that would have been recorded under accounts payable. Now if you see, that's credit. 100,000 plus 150,000, 250,000 debit. So my debits equal the sum of my credits, 100,000 plus 150,000. Now what we need to do is we need to put that into the general ledger account. So let's go down. Equipment was debited with 250,000. And if I go into this equipment account, 250,000, this information would have actually been recorded in 2 journals. That is a debit, 250,000. The accounts that were credited, 2 accounts, bank and accounts payable. There we go. Bank was the cash deposit. Accounts payable is what's still outstanding on the purchase of the equipment. So 100,000, let's say, was for cash. 150,000 is going to be paid over 8 installments. That is the debit entry. Now we need to do the credit entry. Remember, there were 2 ways we paid for this. In the bank account, 100,000. The contra account, equipment. Why don't I use a capital? Typo. It's a name of an account. It's a name, so it should have a capital 1,000. But I put 250,000 in equipment. Now I've put 100,000 100,000 in bank. But that's not the end of the story, because remember, we owe 150,000 because 150,000 was purchased on credit of the total equipment. The contra account here is equipment. So now that's like what I did in the T accounts. I went and debited equipment with 250,000. I credited bank because there was a cash payment of 100,000 deposit and 150,000 still owing accounts payable, which is a liability. Increase in liability, credit. Under bank, the 100,000. Decrease in assets, credit. Equipment went up by 250,000. Increase in assets, debit. Under details, the name of both accounts. You can do this separately. You could have had bank 100,000 and accounts payable 150,000, but I just grouped it together. You can do it separately. Let's move on. Right, next one. On the 9th, purchase trading inventory 75,000 cash. Cash, the one account will be bank. What did you buy? Trading inventory. An asset for an asset, cash for trading inventory. Go and record it now in the general ledger account. I'm not going to do these anymore. Debit trading inventory, the value of trading inventory increased by 75,000. What happened to your bank balance? It decreased by 75,000. So we go to whichever account comes first. Trading inventory, we bought 75,000 on the 9th of April. How did we pay for it? Cash. So the one account is bank. Debit trading inventory. Increase in assets. The value of our stock on hand is increased. Debit trading inventory. And then we go and credit, find it, the bank account. And the amount was 75,000. And the contra account was, what did we buy? Trading inventory. That was on the 9th. We bought trading inventory with 75,000. We've done the debit entry and the credit entry, and we'll be going for almost 13 minutes. Let's move it. Let's move it. It's a pity it doesn't scroll quicker. The owner withdrew 1,500 Rand cash for personal use. When the owner takes anything for personal use, the one account is and the owner took cash for 1,500. Where's the cash coming from? The business bank account in this case. So the two accounts, drawings. An increase in drawings gets debited. 1,500. It's typing slow. Oh, 15,000. 1,500. And the contra account is bank. I know the dates, you'll have to fill them in. That took place on the 18th. Debit drawings, where did the money come from that the owner took for his personal use? From the bank account. So bank, decrease in assets, I did it in 15,000, 1,500. And the contract under details is drawings. That was easy. Next transaction. Scrolling. On the 20th, credit sales amounting to 30,000, cost price 15,000. There are 4 accounts involved. Part A, record the sale. This was a credit sale, which will result in our debtors owing us more. Our debtors in your textbook are summarized under accounts receivable. Accounts receivable is a summary of all your individual debtors. Accounts receivable is an asset. Our debtors owe us more, 30,000 Rand more. Increase in assets, the account that must be debited is accounts receivable. The account that is credited is sales. What was the sales amount? 30,000. So part A, debit accounts receivable and credit sales. Let's do that before we do the cost of sales. So we look for accounts receivable. There it is. The amount was 30,000. The contra account to accounts receivable is sales. Debit accounts receivable, we now need to go and credit sales with 30,000. That would have been recorded in the sales journal. But remember, we're going straight from the transactions to the ledger accounts. There's sales, 30, 1, 2, 3. Under details, the name of the other account that was affected by this transaction. So now we've got 30,000 debit under accounts receivable and 30,000 credit. It's very important that you get these details correct. Now while I'm down here, the cost of the sale. Cost of sales is an expense. At the point of sale, what happens is the trading inventory is expensed. We didn't get this stock for free. We paid 15,000 Rand for it. And if I want to record or be able to establish the gross profit, I need to expense the inventory so I can show the gross profit. Sales minus cost of sales is gross profit. Cost of sales is 15,000. Cost and sales and trading inventory go hand in hand. So there's trading inventory under details. I debited cost of sales, increase in expense. I must go and record in the trading inventory account that I have less stock because I got rid of 15,000 Rand worth of stock, and I expensed that 15,000 Rand and I called it cost of sales. So now that's part B of a sale. You should know that because we've done that quite a few times when we recorded transactions in the accounting table, test 1. So trading inventory was credited and cost of sales was debited. Trading inventory was credited, decrease in assets. Cost of sales was debited, increase in expense. That is known as, at the point of sale, I like this explanation, trading inventory is expensed, shown as a cost of the sale. So we can calculate gross profit, sales minus cost of sales. Is trading inventory account while we're here. We had 75,000 Rand worth of stock because we bought that. And then what happened? We sold 15,000 Rand of stock. If we balance this account right now, there should be 60,000 Rand worth of stock on the shelves. Just interpreting that account. Excuse me. My throat's getting a bit dry. Next one. 29th. The business received 5,000 Rand from its debtors. So let's say we sold on credit for 30,000. Now we're going to get 5,000 Rand. And if it's money that we're receiving, our bank balance is going to increase. So the one account is bank. So we go to the bank account and we got 5,000 Rand on the 29th. 5,000. And where did we get the money from? Our debtors. And what's the account that records or summarizes our debtors? Accounts receivable. So if bank was debited, accounts receivable, decrease in assets is going to get credit. Luckily, it's on the same page. Under details, we're going to have bank. Not banks, but bank. If you see this accounts receivable account now, it says we sold on credit 30,000 and we've received 5,000. 25,000 Rand is still owing by our debtors. That's how you analyze that account or interpret that account at this time. So we received money from debtors, and then on the 30th, paid the first hire purchase installment, referred to the third. Now, do you remember we bought equipment worth 250,000? We paid 100,000 Rand cash. That means we still owe 150,000. And there are going to be 8 installments. Let me show you this quickly. And push the wrong button, but I don't think so. Yeah, I come on my calculator. 150,000 is still owed on the equipment. It's going to be paid in 8 equal installments. They say this transaction, I said divide by 8, is going to give 18,750. We are paying, according to this transaction, the first installment, which is 18,750. If we're paying, the one account that will be affected is bank. And I think that amount, I've already forgotten it, but you didn't, was 18,750, and the contra account is accounts payable. I'll show you why. Because we paid in an amount and we paid money to our creditors because we owed 150,000 still on this equipment, but we're paying 18,750. This is in our bank account, decrease in assets. The rule says credit, and it is on the credit side, the right hand side. So now we go to accounts payable. We owed 150,000 on this equipment that we bought. We are now paying 18,750 back to this creditor that we owe. The contra account, when we made that payment, is bank. If I wanted to tell you what's in this account, 150,000 increase in liability when we bought this portion on credit. Then we decreased our liability, what we owed, by 18,750. The difference between these two amounts is what we still owe. Right, now what we need to do, that was the last transaction. I'm going to show you in a moment the bank account I'm going to balance. Yes, that's a nice one. So if I go up here, I'm going to just work down these accounts. The instruction, the question said, balance those accounts that need to be balanced. Capital, on the credit side, is only one entry. I wouldn't balance that because it already tells me the owner's interest in the business is 180,000. Drawings, it's one entry on the debit side. Don't balance it. Then equipment, one entry. No need to balance. Now trading inventory, we need to balance. I think I'll do trading inventory and bank. So what we got here, trading inventory on the debit side, 75,000. On the credit side, 15,000. Now what we need to do is, when we balance, we add up both sides, we check which side is bigger. 75,000, the debit side, is obviously bigger than the 15,000 on the credit side. You add to the smaller side the difference between the two sides. And I can see that is 60,000. So I said 75,000 minus 15,000 is 60,000. And that is called the balance carried down, which is done on the last day of the month. Then what we do, according to manual bookkeeping balancing rules, we add both sides up on the same line. And both sides now equal 75,000. But what is the balance of trading inventory? 60,000. On the last day of the month, on the first day of the next month, we have the balance. I always spell balance wrong. We have the balance brought down on the opposite side to the carry down, and you keep the amount 60,000. So what it's saying is when we start May, on the shelves, we should have 60,000 Rand worth of trading inventory. Now that account is balanced nicely. Mark allocations, 1 mark for the amount, 1 mark for details. 1 mark for the amount, 1 mark for details. There might be 3 marks for balancing, for getting the balance carried down on the correct side, totaling up both, another mark, and on the opposite side to the carry down, you have the brought down, another mark. So you need to balance correctly. Let's move on. Remember, you can always stop the video and watch again. Now, accounts receivable has an entry on the debit side and the credit side. You'll balance it, just like the trading inventory account. But I want to do the bank account because there are lots of entries in here. So on the debit side, you got that capital contribution, and we received money from debtors. So in the month of April, 185,000 ended up in the business bank account, but 100,000 was used for equipment, 75,000 was used for trading inventory. The owner took 1,500, and also who was paid? Creditors were paid 18,750. Now what you need to do is you need to check which side is bigger. So if we say there's 185,000 on the debit side, add up the credit side. I'm going to add that up quickly. Let me get my calculator. And I'm going to say 100,000 plus 75,000. I know that. That's 175,000. 175. 1, 2, 3. Did you see that little error? Be careful. 175,000. That's the 100 plus the 75 plus 1,500 plus 1,500 plus 18,750. 18,750 equals 195,250. 195,250. Now I can see that the credit side is actually bigger than the debit side. So what has happened is this bank balance is going to go into overdraft. And I'm quickly going to find the difference between the credit side and the debit side. So we've got 185,000 on the debit side. 195,250 was the total of the credit side, minus 185, 1, 2, 3, equals 10,250. 10,250. Okay. On the 30th, that is the balance carried down to make the two sides equal. There I did it again. Balance carried down. And if I add up both sides on the same line, both sides now should equal 195,250. Then on the first day of the next month, May 1, balance. That's underlining everything. It shouldn't, or you shouldn't. You only underline the totals. 10,250. That is the balance brought down. Now look, that carried down. We spent more than what we had, but luckily we had an overdraft facility. And the balance ended up now on the credit side, saying that we actually owe the bank money. So we've gone into overdraft. I like to be as well. That looked a bit untidy. So we take away the underlining. Looks a bit better. Could have underlined that. So now I've balanced the bank account. And if I look here, this bank account is saying that I've gone into overdraft, and the balance at the start of May is now on the credit side, 10,250, because that's an increase in a liability to the bank. When you go into overdraft, you need to pay back. So this exercise, taking funds from the general ledger, taking transactions directly to the general ledger accounts. You need to practice this. And there is the beautiful class I had today. And there you go. There's your nice picture. And to all those who went there, I hope your test for your other module went well. Watch this video. It's important. Also, in this test coming up, is drawing up a trial balance. We've done a couple of exercises like that, but this is the tougher one, doing the general ledger accounts. So watch this. Okay, cheers everyone. Bye.